If it does not produce income, it is not an investment. It is simply a speculation. It is simply a gamble, right? There are many investors, well, I should say people who call themselves investors, bless their hearts. And I used to be one of these, right? But I got a little older, I got a little more conservative, and I thought, it's kind of hard to earn your money. I don't want to lose it anymore, right? So I want to be an investor, not a speculator, not a gambler. I like to invest for yield, for cash flow, for ROI, return on investment, as you go along. See, the problem with investing for capital appreciation, the old mantra of the non-dividend paying stock investor, the precious metals investor, the cryptocurrency investor, or the investor, well, they call themselves an investor, in real estate, in a cyclical market, which we will talk about that in the future, the 3 different types of real estate markets. That type of investor or really speculator is doing the buy low, sell high business plan, right? The buy low, sell high. The problem is, I have never, in all my years in the business, and I've been doing this a long time, since I was 19 years old in my first year of college, I got into real estate. I always wanted to be a real estate investor since I was 16 years old. And in all that time, I have never met anybody who can accurately predict the cycles in the real estate market. Yes, I've met quite a few gurus who claim to be good at this, and they'll be good for a while, okay? And then they'll be wrong. They'll be good until they're wrong, right? There's an old saying, a broken clock is right twice a day, okay? We all know that. So with this, you don't want to gamble. You want to invest for cash flow. If you are buying properties in these cyclical markets, right? The markets where if you're looking at a graph, they go up and then they go down and then they go up again and they go down. That's a cyclical market versus a linear market that has little ups and downs, but they're minor. It just kind of chugs along and does its thing over time. And the linear markets have very good cash flow versus the cyclical markets that have terrible cash flow. So you are stuck in the environment where you must buy low and sell high, and you must time the market accurately. That is not investing. That does not produce income. That's why we know it's not investing. If it doesn't produce income, it's not an investment. It's a gamble. Commandment number 5, be sure to obey this one. Thou shalt not gamble. Now, one caveat on that. I know I said don't gamble and follow commandment number 5. However, if you are doing well and you have achieved some financial success, whatever that means to you, and you've got a little money to speculate with and take a gamble with, that's okay. Okay, if you take 10 or 15 or maybe even 20% of your net worth, depending on how high your net worth is, and you gamble with it and you think, hey, I might hit a home run here, and you might, then that's okay. I don't want to say that you can't do this. I'm just saying, depending on your age, and in the prior video, we talked about financial planning, depending on your risk tolerance, your time horizon, your investment goals, right? Tie it back to that one. You want to consider investing for cash flow, for yield. That's an investment, something that produces income versus something that's speculative. So I hope that helps. And I want to wish you all happy investing. If you have a comment, leave it below or go to jasonhartman.com/ask. Questions or comments, and we will see you on the next video. Until then, happy investing.
So I'm one of the preferred lenders with Jason and his team. I work with all the investment counselors, work with all of their clients to help finance their properties. So as Jason's students learn about purchasing new homes, we teach them how to finance the homes, and we provide the financing for them. So we're one of the preferred lenders that has consistently worked with the Hartman Group for these number of years. For us, it's business, right? So we're working, it's a business to business relationship. We obviously are selling mortgages.
All right, let's go. Let's get started. Can you hear me, Sara?
Hey, Jason, I can hear you.
Okay, your sound is very loud. Yeah, okay. Maybe it's better now. It might have been my volume. Good morning, everybody. Good morning. How's everybody doing? It's early for some, and we appreciate you joining us. It is great to have you here. So first of all, Sara, do you have your coffee?
I have my coffee.
Okay, well,
Baseball,
this is
baby.
like Scott Adams does the synchronized sip. Everybody, cheers.
Cheers.
Sara was thinking we should put Bailey's in the coffee.
Hey, I wouldn't argue with it.
There you go. There you go. Well, I hope everybody's doing well. And we've also got some clients, Dave and Gina, on with us. And I see them there in the green room in the studio. Hi, guys. How are you? So, hey, maybe I'll start with a little update on what's going on. You know, we are living in absolutely crazy economic times. I don't think anyone has to tell you that. And it is rather surprising to me, and maybe surprising to a lot of people, that the market is booming. I mean, a few months ago, we probably all thought the world was coming to an end. No one would have surprised for anybody to think that. But we are seeing major housing shortages. As you can see on the ticker on the screen, home construction up 17.3% in June. You know, I don't deny for a moment that the housing market and the economy may be changing in the future. I think we have not seen, you know, the end of this. Like I've said before, I think we're in just the third inning of a 9-inning game with this. And so it's still very early to tell. But Sara, you are our top investment counselor. Tell us what you're seeing out there, what clients are saying to you, and kind of what's going on.
Yeah, I mean, when this all hit in March, we were all just shocked. I was getting some phone calls from people that were concerned. You know, are my tenants going to pay rent? You know, what do we do? And it was kind of just a hurry up and wait. We just were sitting around waiting to see, you know, what April 1st brought. And, you know, most people got their rents. We didn't have any issues. I had a couple tenants that didn't pay. We had some challenges for sure. And then it just, you know, well, the stimulus money kicked in. So that, that helped.
That didn't hurt, right? A lot of fake government money, a lot of fake fiat money.
Yeah, I mean, you know, we're in the rental property business. So the first thing everybody thought was, you know, we've got these mortgages, we've got these properties. Are we going to, you know, collect rent? And of course, I had the same concern. So March, everything kind of just came to a standstill. And then April, I don't know what happened. I know what happened. The rates dropped. Fed cut the rate, and it took a little while for the mortgages to follow. But then the mortgages did follow, and everybody, the refinance frenzy occurred, and everybody just started applying for loans. And so that's kind of what got everything going again. A lot of cash out refinances, a lot of just restructuring of debt, maybe lowering their payments, pulling out the cash just to have some extra cash reserves. A lot of people were asking about forbearance. I qualified for one on one of my loans, and I just
did you take it though? You didn't take it.
I kind of inadvertently did take it, but I got nervous because I wanted to qualify for those refinances. So what I ended up doing was just paying and taking myself out of it. We had some clients, you know, take it, and then their tenants paid. So.
Yeah. Well, on the ticker now, at the bottom of the screen, just talking about what you just said, literally, there's a great book, by the way, that I read. I talked about it on the podcast extensively. It's fantastic. It's called Debt, the First 5,000 Years. Forgive me, I can't remember the name of the author. But if you look at really long interest rate charts, the mortgage rates we have now are the lowest ever.
Well, I've been working with you for 13 years.
Since they built the pyramids. Okay.
Right.
It's crazy.
Did they have interest rates back then? I don't even know.
No, it's not quite the same. But, you know, there are long-term studies of interest rates. I mean, going back thousands of years, okay? You know, to before when Jesus tipped over the tables of the money changers, right, in the temple. I mean, you know, there are very long studies of interest rates because there's been a cost to borrowing for a long time throughout history, and it's not a new phenomenon, right? Of course, we have a much more developed market nowadays, but yeah, and the rates you're seeing, by the way, I changed that headline that I put on the ticker. It's owner-occupied rates. That's a very important distinction because investors, you won't get those kind of interest rates. Sorry, they charge a bit of a premium for investors, but still the rates are very, very reasonable. And to dovetail off a comment Sara was making a moment ago, just remember something. Yes, people benefit, buyers, investors, and homeowners just refinancing their mortgages. They benefit from lower payments and all the savings that can generate for them. But you've also got to remember there's a huge knock-on effect because the real estate industry is this giant industry. Okay, it's a giant industry. And there are so many people that benefit from the refi boom or the purchase boom and that money flowing through the system. You know, obviously home builders, obviously construction people, obviously suppliers, but, you know, have you thought as much about the title companies? The mortgage people obviously benefit, you know, all of those escrow holders, the software suppliers. I used to own an escrow company. I've owned a few mortgage businesses over the years. You know, there are just a lot of people that benefit when the mortgage industry is slammed with business. So, you know, it really is very stimulative for the economy. I remember I was interviewed years ago, back in the 90s, when I lived in Orange County, California, and we were in a recession at that time, and a TV crew came out with the cameras and, you know, interviewed me, just wanted to get a comment on, you know, the housing market and how significant it is for the economy. And back then, I'm sure it's different today, but back then they would say that the average person, when they buy a house, spends about $15,000 more. Even if they buy a new house, there's a lot of stimulation that goes on in the economy because suddenly everybody looks around and realizes, well, you know, we need new furniture, we need new this, we need new that, you know, and so real estate is a giant industry, and there's a lot of follow-on effect to all of this, all of these low mortgage rates and so forth. And look, I'll be the first to tell you, we are in a fake economy. But it's not just the US. The entire world economy is fake. I mean, we're playing with fake money, fake stimulation in terms of all these stimulus packages. You know, the whole thing is just like this crazy house of cards. You know, you just have to understand that. And so when people criticize the US economy and they say, you know, oh my gosh, well, you know, it's just the dollar's not backed by anything. Well, you know the question I'm going to recommend people ask, right, Sara? Compared to what?
Compared to what?
You know, compared to what, right? And that's the question we have to ask. So it's always hard to make predictions. Predictions are a dangerous business in a world where there's so much government intervention and so much central bank intervention. That's the thing we have. By the way, to our listeners, we got a couple comments coming in for viewers and listeners. By the way, Ivana, you said no sound, but I think the sound's coming through now. So I'll double check that. Dave and Gina, wave your hand. You can hear us, right? Yeah, okay. We'll have you here in a moment.
I can't see Dave and Gina. Hi, Dave and Gina.
I can see them. So anyway, yeah, it's a crazy world we live in, and it doesn't make any sense. Don't expect it to make any sense. But you know, we do know that the good old government will be there to step in and be involved in the market. Yes. The U.S. economy, and we have sound. I just checked it. Okay. So that's good. So please post your questions and comments, and we will be happy to try and get those. Oh, Ivana, thank you. Yes, I just saw your message. Everything's fine. Good. Okay. Well, hey, let's bring Dave and Gina in. Are you guys ready back there? Here you come. All right. Dave and Gina, welcome. How are you?
Hello. Good. How are you?
Good.
Hey,
Good.
guys.
Can you hear us okay?
Yes, we can. We can hear you great. And you are in Folsom, California, Northern California. Is that correct?
Yes.
For the next 6 months.
Oh, I don't know about this. Is this an announcement? Now, Dave and Gina have been clients of ours for a few years now. I first met them when we did a property tour or a little seminar in Oklahoma City. I think that's when we first met, right? Yes.
Yep.
And you remember I was all excited about my new microphone when I had you on the podcast.
That's right. Walked and talked.
Walk and talk, yes.
Yeah, we did. We took a walk back, and we did a podcast interview while walking back from lunch. So you're moving.
Well, yeah. Well, we have been talking about it for years. I think I've talked to Sara. Actually, we talked to Sara about it on through Facebook, and we hinted about Idaho, but we didn't say anything. But we went up there in March and started looking at property, and we actually picked out a lot in a little north of Boise.
Yeah.
So yeah, we're in a great spot here. We love it. So we had to get something with the kind of recreation and great activities we have here, mountain bike and that kind of stuff.
Yeah.
And of course, this is the great spot in the Socialist Republic, but we always wanted to escape.
Yeah.
So
Escape the Socialist Republic of California. Good idea.
Take me with you.
Highly recommend it.
It's getting worse. So just the climate, political atmosphere here is getting worse and worse. And when we were going to go till about 2 years from now, but Gina, amazing as she is, she already got licensed in her practice up there. And went on work speed. She's licensed in California and Idaho, so she's doing teletherapy now through the COVID stuff. So it's been laid out for us.
Good stuff. Good stuff. Well, hey, tell us why did you get interested in real estate investing?
Yeah, that's a great story. Well, after 2015-ish, where I got kind of my mental focus on things other than what I was doing before 2015, that's a different story. But then in early 2016, I was working with Con, one of your clients, and he and I got into a conversation at dinner about real estate, and he mentioned your network. So, and I was ready. I was ready at that point mentally, and we had some finances. So we started investing, and I really wanted to help with helping pay for Megan's college, my youngest, and so that we didn't have to take student loans out, right?
By the way, isn't it just totally ridiculous that you should have to have an investment plan to pay for college?
It's a scam.
Yes.
It's an absolute scam. I mean, college is the
Awful.
most overpriced scam in the world.
But it's the reality when
We're paying $850 a month for a 1-bedroom in a 4-bedroom apartment. So, just because it's near the college, right?
Yep.
And that's just the tip of the iceberg, of course, with the other expenses. But yeah, and University of Northern Arizona is a great school, but
it's college.
Yeah, it's college. But
Business.
It's a business. It's not really education. It's about being in a business.
Yeah. Colleges, people are now calling modern universities, they're just basically hedge funds. That's all they are. They're hedge funds. They're huge real estate investors. They play the stock market. They're, branding and marketing companies. They've just totally lost sight of education, but that's for another discussion.
Well, yeah. So we went on the journey and hooked up with Sara, and I'd never done any real estate investing outside of primary residence. So she's been amazing every step of the way. So I always thank Sara because she deserves it. And we trust her with our finances and with recommendations all the time. And she's guided us and given us lots of education. It's like your podcast and Meet the Masters. It's very valuable. So Gina, the good thing is Gina was 100% behind it. She was not fighting that at all. She knew, like I did, that was the right direction to go. So that helped a lot.
But I will say I was a little, the whole concept of not seeing a property, and
Right.
We had inherited a little bit of money. My parents had passed away, and he said, I want to buy real estate. And I was like, but in a state we've never seen property, we've never done this before.
You must be crazy, right?
Right. And, and so he showed me everything of this little house in Ellenwood, Georgia. And it was our first house. And it's actually been one of the best properties that we've had. It's actually in a market that actually accrued value.
Right.
That's it became hybrid, and it's worth like $135,000. We paid $86,000.
Fantastic.
And getting Sara, and that's not normal, as you would mention. That's not normal.
Right.
but we
Yeah.
got lucky on.
It's nice to have some of those. Yeah. I mean, so we talk about, for the listeners, we talk about linear markets versus cyclical markets. And then, we hope to get involved with a hybrid market at the right time, right?
Right.
So, California would be a cyclical market where you see the high highs,
Yep.
the big drops.
Right.
And then, Atlanta was just kind of chugging along, and we have a property in Atlanta too. And, talk about just being in the right place at the right time and, making a decision and pulling the trigger, because that did end up being a very good market for a lot of us.
Yeah.
No question about it. So linear, cyclical, and hybrid markets, that's what they're referring to. And how many properties do you guys have now?
It's funny, Gina was asking me that this morning, and I was like, I better find out.
You lost count.
Well,
Isn't that great?
Well, Gina's buying some in her IRA, so but anyway, we're in escrow on a duplex in Palm Coast right now.
Uh-huh.
So that'll make 31 doors.
Fantastic, yeah.
Wow.
And 27 of them I want to mention is through your network.
Mm-hmm.
So
Fantastic.
vast majority, obviously, and we partnered up after we bought our first 8 or 7, 8, and then because we ran out of money, and then we wanted to keep going, so we partnered up, and we have a great friend that we knew before we partnered up with him, an amazing guy and multimillionaire businessman, and he's our tax guy too. So anyway, that allowed us to go from 7 to 31 in a few years. So, and she's got several on her own. I have some on my own, and then we partner up on some. So it's kind of a mix. But so far, it's worked out really well.
Mm-hmm.
What year did you buy your first property? When did you start?
Yeah, 2016 in April.
Yeah, wow.
You
So
were
31 doors in
I got
4
on
years.
the phone with you in early March. I got on the phone with you. I had listened to a podcast starting from late January to all of February. I was listening to Jason's podcast and you guys all that time, and I felt a little better because it made so much sense listening to Jason. So in early April, I gave you a call, and you walked me through the Deer Run property in Ellenwood, and because I still had no clue what I was doing, so I learned on that property with you, and then we just started into Memphis and other places.
Good stuff. Good stuff. So
Congratulations.
31 units, fantastic. And what markets do you own in now? You have Georgia, Ellenwood, Georgia. You have Memphis. What else?
We're in Chicago, Illinois area. We have just a few there, and Ohio we have 5, and we have some in Arkansas and Florida. Florida's really become our favorite right now.
Yeah. Where in Florida?
Ocala.
Yeah, Ocala, Jacksonville, and Palm Coast.
Okay. And the Palm Coast one you're buying now, the duplex there, right? Yeah.
Yeah.
So why has Florida become your favorite?
Well, I know early on, new construction wasn't all that appealing because of the numbers.
Mm-hmm.
But now, and I think I've listened to you on the podcast, and you've mentioned how much more beneficial new construction is now. And the
If you
appreciation,
can get it, we like it if we can get it. Yeah.
right? But we noticed the appreciation, and we did a lot of communicating with you and Jim, with Sara and Jim, and it just became really attractive because we were getting some extremely difficult maintenance issues at Memphis and Chicago, and we worked with Sara on a bunch of those, and some of the stuff wasn't making any sense, and we booted one of our property managers. Actually both. We booted our property manager in Illinois, and Sara got us a really good one starting in January, and it's been so much better. And also in Memphis, there was one point we paid like $12,000 in 1 year over just 5 properties, and just maintenance, not property management fee, and it was not that good before and even after that period, and then I finally booted them, and it's been much better then. So anyway, but that's one of the reasons, maintenance. Ohio's been really good, and Arkansas has been pretty good. I forgot to mention Arkansas. Little Rock, we have 3 properties there.
what are your plans for your portfolio? I mean, you guys are in enough markets. We recommend people be in 3 to 5 markets. So
We are
don't get too
at 4.
diversified. That's the mistake I made when I started doing this. I was
Yeah.
at one time, I owned properties in 11 states and 17 cities. And I've been trying to unwind that over the years to actually diversify less. But, you know, it's like going to a buffet. Your eyes are bigger than your stomach sometimes. Yeah.
Well, we thought about that because we've got, I think, a one-off duplex in Indiana that he bought on his own, and then of course our first one in Georgia is the only Georgia property that we own. You stopped looking at that market very shortly after we had purchased that one. Yep. Because the market got a little crazy. And so we were like, oh, we should offload those, but those properties are doing so well for us now. It's kind of hard to walk away from them, especially the one in Indiana, because that one took us a while to get that one to actually be kind of a cash flowing cow. And now it's doing great. And so even though it's a one-off, it's hard to go, you know, we kind of know where we need to get rid of them to condense, but
eventually we will. But
sure.
You can get to a point with your properties where you have an infinite return, right? Where, you know, you get into the refi till you die strategy and you extract that equity, and it's almost like you hit the reset button on the cash flow, right? Because you pull out some of the equity, and then, but if you can get it to still cash flow, it's like, why not just keep it, you know, and let it run its course? Then you can use that equity to roll into more properties. So, and Jason, we did have a question about that. You know, how to harvest your equity. So Levi, thank you for that question.
Yes, let's put that up. I wanted to take that question. So Levi is asking, good morning, Jason and Sara. What is the best way to harvest my equity in the cash flow investment property? Is it cash out refinance or HELOC? Good question. So what that really means is, are you going to do one loan, meaning you do one refinance, you refinance the underlying mortgage, okay? Or mortgages, if it's several portfolio of properties you're talking about. You refinance all of them with a single loan on each property, or you could even do, if you do a portfolio loan, you could potentially get a blanket loan for all the properties. So just want to mention that. And, or should you get a HELOC, a home equity line of credit, and leave the underlying loans alone and just pull equity out with that second loan? Now, the HELOC is almost never going to be fixed rate or 30 years, okay? So it's probably not going to be as desirable, but it might be. You just have to analyze it on a case-by-case basis, because part of the thing that comes into play, Levi, with that question is what is your underlying loan like, okay? Or underlying loans, if you're talking about a portfolio of property. What is the rate on those loans? How much time do they have left on them? One thing that people do forget, I'm big time in favor of refinancing, but one thing people do forget is they are extending their mortgage when they refi, and they're re-amortizing it. So all mortgages are amortized, and amortizing means you're paying principal and interest. It comes from the Latin word amort, which means to kill. You're killing the mortgage over time, right? You pay most of the interest up front, and then you pay very little principal, and then later in the loan, you start to pay a lot more principal and a lot less interest later. So the lender gets their money first, basically their interest, okay? And in doing that, the one thing you do lose on the refi to die strategy, although you gain tons of things, so I still think it's a great strategy. You do lose return on amortization, which when you start digging into that loan 8, 10, 12, 15 years in, the return on amortization becomes pretty significant. At last year's Meet the Masters, and Dave and Gina, I think you were at that one, right? Were you there? You were there last year, right?
Yeah.
In Newport Beach, we demonstrated ROA, or return on amortization. So Levi, to answer your question, it depends. It just really depends on an analysis of the first loan you have, what you can get on a cash out refi versus what you can do on a HELOC. I'm probably going to say that the cash out refi is going to be the best deal, very generally, without even knowing the underlying interest rates or anything like that, okay? So good stuff. Dave and Gina, have you refinanced any of your properties yet? You may have mentioned.
Not yet. We looked at the one in Indiana she was talking about, because I have about probably 50% equity in that one, maybe more. That one's appreciated too, but I started the process and we had a problem with the title, not title, with the permits, or how the land was. The guy previously, they had turned it into
Entitlement is what you're talking about.
yeah, they turned it into a duplex, but they didn't go through the proper methods to do it. So when I looked at it, the county didn't have it as a duplex, so I had to back out of that one.
Uh-huh.
That was a one-off that I talked to Sara about, because I wanted to dump it, and now it's cash flowing $1,200 a month, and I'm paying $500.
Fantastic. And
So-
how much? What's your loan to value on that one? You got $1,200 a month cash.
I owe about I owe about 48,000 on it. It's worth about 120-ish, 110 to 120.
Yeah.
So
yeah,
yeah,
we do want to refinance that one fairly soon and get that equity out.
Well, the issue, that's one of those ones I think I talked to you about. I did on a previous interview with you, and that was the one that didn't cash flow for 2 years, and I made a mistake on it. Went a hard money loan and didn't do enough research and enough diligence. So I learned a really good lesson there. It took me 2 years to get it to cash flow, like Gina mentioned earlier, but it's cash flowing like crazy, so I'm not going to worry too much. I think I just sell it and then 1031 it.
Mm-hmm.
I think I might end up doing that, because that's the one-off, like you talked about. We have 4 one-offs,
Right.
and the rest of them are in 5 solid markets, and those
Mhm.
one-offs we can eventually like 1031 into our solid markets.
Yeah. And the one-off means that you've got one property in a market, and you want to undiversify sometimes if you've over-diversified.
Yeah, 9 markets, that's too many.
Yeah, I agree. 9 markets is too many. 3 to 5 markets, 5 being the max if you can do it. Dave and Gina, I forgot to ask you at the beginning, just to give a little background, tell everybody watching, what do you guys do for a living?
You want me to go first?
She's the most impressive, so
Oh.
she needs to go
She's
first.
the head doctor.
Yeah. I'm a mental health therapist. I own Authentic Gains, and now it's going to be both in California and in Boise, or the whole state of Idaho. So I'll be doing both telehealth. So he's more the real estate guru. I kind of come and learn. I know enough to get dangerous, and be dangerous and ask like the questions that drive him crazy. But most of my focus has been obviously in my business and building that. And
I love dangerous, Gina.
That's why we're such a good fit with you. Yeah, but yeah, is that?
That's what I do. What do you do?
And Gina, you specialize in the mental health field. You specialize in like the mother-daughter relationship, right?
I do have a specialty in that. Mostly, I work mainly with women. Probably my practice is 90% women, but it's all about working on vulnerabilities and walking into hard conversations. And, whether it's individuals or couples or mothers or daughters, it's teaching people how to deal with shame triggers and develop resiliency skills to be able to move forward and get rid of all those kind of negative thoughts that get in the way.
Good stuff. And Dave?
Oh man, how do I top that one? I don't need to.
Well, you work with the opposite. You work with computers, so that's
Yeah, I'm in IT. I've been in IT for 35 whatever years since I got out of college. But I'm in a healthcare field and application supervisor up here in Northern Cal. So our team builds the COVID test and the COVID location. So I'm very intimately familiar with what's going on with the testing in the background in the laboratories, because I'm a lab app supervisor. So that's kind of where I'm at now. And my plan obviously is to transition out of there whenever we can, when I think she's going to become a millionaire here in her business. So
Yay.
We'll just hope for that.
I'm putting that out in the universe because it's entirely possible with her.
I love it. Yeah,
Put it. I'm catching it.
that's great. Yeah.
But yeah, so it's been great with her building up Authentic Games. So she left the corporate world 3 years ago, not having any clients, and just hung a shingle out but got an office and built a business that was self-sustaining in 6 months.
Yeah.
It was like, wow, okay. So when I saw her the other day, and she's talking about expanding, and I'm like, okay, I'm not going to get in the way of that.
That's why I need to get out of California so I can build it.
Yeah.
Right. Yeah. So California is not business friendly at all. I recommend leaving. It's where I spent the vast majority of my life, but get out of that state if you can. It's just too hard to do anything there. So what is your goal in terms of like number of units of properties? So you've got 31 units now. How many do you want to acquire and how much time?
I'm glad you asked that because we're shooting for 100 units. That's our goal because I have a real big, I know that that's going to happen. And I'm putting, this is an aggressive goal. I'm putting a 5-year on that, which is aggressive.
Mm-hmm.
It's aggressive. So when I get 59 and a half and I'm 58 now, so when I can get that, there's a lot more, there's some money I can get at that won't get killed by taxes, and plus we'll be out of the California. So we won't get murdered by the California taxes when I do that. So I can get access to more funds to buy more properties. So we're looking at definitely moving forward.
That's fantastic. That is totally awesome. 100 units in the next 5 years. That is a fantastic goal. So good for you. Good for you. Awesome.
Now you just have to train up the kids and get them to manage them for you.
Right. Yeah.
Go. Yes.
There you go. Yeah.
They learn how to manage their own finances before they start touching that portfolio.
That's a good topic because my son, we've been kind of mind melding on my son, and he got out of the Army, he banked up some like 20 grand-ish or something, and when he gets out of college, we're going to definitely get him to invest in property when he gets his credit rating up, and I may partner on a deal with him.
The younger you can start, the better.
Yeah.
Get him to meet the masters. It's all virtual.
That's fantastic. How old is he?
He's 22.
Okay, so Sara, you know this from over the years. I mean, we have had a lot of kids come to our seminars. I mean, not a lot, but it just it surprises and impresses me that we've had 10-year-olds, 12-year-olds that really have truly become very interested in income property as an asset class, coming to our events with their parents. I just think that's totally awesome. I mean, I was 16 when I got the bug, so it's really amazing what you can do in terms of that. Well, good stuff, Dave and Gina. We won't keep you forever. We appreciate you dropping in, but do you want to share just any tip with people before you go, or any thoughts, whatever it is?
Actually, I did want to talk a little bit about the loan environment. Ask you. We started with we closed on a property in May, and when we started, it was pre-COVID, right? And that was a Jacksonville property through Jacksonville.
Yeah, got it.
That was with Joe, so it was kind of appropriate to have Joe at the beginning. And Joe helped us a lot through that process because during that process, it became increasingly more difficult as they were asking for more and more and more, and to explain
in terms of more and more, you meaning paperwork, documentation?
Yeah.
And then what I was surprised by is this had never happened. We were about to close, and I got on a phone call with my HR to ensure that I was still employed the day before.
Oh, God.
I never had to do that before. And during that process, I kind of started getting irritated a little bit towards the end because Jack's Wealth already in Suncoast, they're great. They had a tenant in there already, and we were not closed. So because of the delay in what they were asking for and stuff, and I kept giving them stuff and then waiting. And so I got irritated with Joe a little bit, and he kind of walked to me and held me. He was very patient, and in the end, I said, sorry, man, I owe you a drink.
So other than getting a free drink out of it, what's the question there?
So what I wanted to know is moving forward now that the rates are fantastic, and now we know the requirements are a little more stringent. What do you see moving into end of 2020? If you have any premonitions or about anything about 2020, 2021 of what we could be looking at regarding loans and things?
I think your rates are going to stay low for the rest of the year. I don't think you have to worry too much about anything, but we do have an election coming up things could change. Of course, either candidate has an incentive to pressure the Fed to keep them low. Now, remember, the Federal Reserve does not directly control mortgage rates, but they certainly influence them. The likelihood is rates are going to stay low. The problem you're going to have is that with rates so low, it's causing upward pressure on prices. Now, that's uneven, okay? And that's why you hear people talking about, the coming housing market crash. Well, they're not completely wrong, because the housing market crash is definitely already happening in high density urban areas. Those are areas that are largely, almost exclusively cyclical markets that were overpriced already, that were already softening, but COVID and then, riots in the streets obviously added to that downward pressure on those markets. But these little linear markets with inexpensive properties that we specialize in, those are booming. I mean, inventory is super tight and prices are on their way up. So that's the problem you have with low rates. Now remember something else too, that 1% in interest rate is, first of all, not really 1%. It should be viewed as a proportion to the rate you're already paying. So if you've got a difference between a 4% and a 5% mortgage, that's the way you have to calculate that. That's not a 1% difference. Okay, it's what, a 20% difference, right? Depending on which direction you're calculating it, of course. But the mortgage rate to the price, 1% will equal about 10% in purchase price. Okay, so if the rates go up 1%, the price has to come down 10% to make it about the same, or vice versa. Okay, so that's just it's a rough, it's not exact, but it's just a rough rule of thumb that you can use to calculate that. So I think you're going to have low rates continue. I wouldn't worry too much about that, but what I would worry about is seeing that upward pressure on prices.
Great, thank you. That's cool.
Can
I mention real quick?
Yeah.
One thing, we're talking about the loans, and the one for Palm Coast. This was another interesting thing that I hadn't encountered. Was we got the duplex, and I was talking to Joe last week.
Mm-hmm.
I wanted to put 20% down, which we had done in Ocala, a couple years ago. But he said you cannot do 20% down on a duplex now. You have to do 25 on the duplex.
2 to 4 units, will be 25% down.
So yeah, which was great, because it's astounding what the loan rate we locked in was 3.7, something like that on a. It's nuts.
I'm glad you mentioned that. So
Yeah.
Remember the calculation I did on the air on the podcast with Evan about his property, that I think he got 3.75% on the short-term rental in St. Augustine that he purchased through our network. And you're getting paid to borrow, literally. So if inflation is 2% and your tax benefit, without even considering income, assuming the house is vacant and there's no income, okay? If your tax benefit basically equals about 1.5% just on interest deduction alone, okay? Now, remember, interest deduction is offset against income. I'm just assuming the property's vacant. Like, say you never rent it, which would be ridiculous. Of course you would rent it, right? You're getting that loan for free. It's absolutely amazing. And with the real rate of inflation, and by the way, I should mention this, Sara, you may not even know this, but one of the things we're really excited about doing at our upcoming Meet the Masters conference, that's a virtual conference that's coming up July 31st. And by the way, for anybody who stays to the end, I'm going to give out a promo code where you can get $100 off your tickets for Meet the Masters. So Sara, don't let me forget to do that before we wrap it up today, okay? I will feel very guilty if I forget. We're going to introduce a couple of new calculators. One is the real inflation calculator. We're trying to get that finished now. So it's not like these fake inflation calculators that go by the official understated rates of inflation. Okay, it is a real inflation calculator, meaning that you're going to really know what happened to the value of your dollar over time in real life. Okay, so that's a huge difference, right? A real inflation calculator. And we've got the other one that our client Ross developed that we've embellished a lot and added a lot of features to it, that shows you how to acquire his goal, which is 100 properties in 10 years, by the way. I know you guys want to get to 105 years. He's younger than you are, so he's starting out, a little earlier. And so probably doesn't have as much in the way of resources to invest. I don't know. But yeah, he's going to get to 100 properties in 10 years. And it's amazing. It just shows you how you can do that, because you acquire some of the portfolio through cash flow and refinance, not through new money that you put in. It's just an income property is a beautiful thing. It really is. Yeah. Good stuff. Good stuff. Well, thanks for joining us. Appreciate it.
You're welcome.
Love it.
Thanks, guys.
It was good having you on.
I'll see you on Facebook, man.
Bye. And we'll see you on July 31st too.
Oh, yes. July 31st.
Okay. Well, Sara, that was really fun to have some actual clients on talking about their stuff.
Yeah.
So that was really great. Dave and Gina are just awesome. They're just great people. So good stuff. We've got let's get to a couple. I think we got a couple more questions.
We had a question from a listener in Puerto Vallarta on the down payment money.
Mhm.
Can investors apply for owner-occupied loans at 3.5% down payment?
Yes, that's from Mercio, right?
Yeah.
No, you can't do that. That's for owner occupied. Okay, so those low down loans are owner occupied. That's probably an FHA loan actually that you're referring to. And one of the things people do if they're just starting out in their real estate investing career is they do what's called house hacking. They either move into a single family home themselves, they get an owner occupied loan, they don't lie about it, they actually move in and live there, and they get the fantastic owner occupied loan terms, which means a lower rate, a lower down payment, and they move in and they'll live there for a year or two, and then they turn it into a rental. They buy a property that would make sense as a rental. That's the key though. It's got to be the right market.
It's got to be the right market. Yeah.
Yeah.
And if you're in a higher end market, like, I'm in Southern California and we got started by just harvesting our home equity. We tapped into a line of credit. So we did get 100% financing on our very first income property. But when you do that, you have to just be really careful not to over leverage. You've got to have a nice, cash reserve on hand. So when you extract the equity from your home or your home equity line of credit, make sure you take enough out to keep on the side for your reserves.
Yeah. So what you're saying when you 100% financed it is you didn't finance it through the loan on the new rental property you were buying. I think that was your first property in Houston, right?
Right. Yeah. So I borrowed the down payment from a line of credit. So on investment property financing now, you have to put 20 to 25% down. And it should be noted that if you put 25% down, you're going to get a little bit better interest rate too. But yeah, so when I bought that first property in Houston, it technically was 100% financing because my down payment was borrowed. So I took the 20% down, and then I got a new loan for the Texas property. But yeah, I was paying, back then, I think my HELOC was at 6.5% or something like that. Right. So now, since then, I still have that property. In 2016, I extracted all the equity out of Houston. I pulled out like $50,000. I mean, I never put any of my own money into that deal. And, 9 years later, I took out $50,000 to roll into more deals. So that really is the refi till you die strategy.
Yeah, it absolutely is. Income property is one of the rare asset classes where you can get all your money back and still own and control the asset.
You still have the property, and because the rates are so low.
In most assets, you have to sell the asset to get the money out. But with income property, and one of the reasons it's the most historically proven asset class in the world is because you can get your money back without selling the property. It's a beautiful thing.
Yeah,
Isn't it?
and that's one of my, what I would call an infinite return property, is that I still have the property, it still cash flows. And with the interest rates being as low as they are today, I was able to restructure that debt. So I would highly recommend, if you have properties right now and you want to harvest the equity, especially if you're in a market like California where, you could see you could lose a lot of that equity. So it may either be time to sell or, extract the money and put it to work while you can. I'm working on a refinance on my primary residence. And from the time I started to the time that I got the actual appraisal, the Zestimate dropped.
Mm-hmm.
So, I didn't get as much as I would have liked to on that appraisal. So, that's happening in real time.
Yeah, and it definitely is. It definitely is. Okay, so one of the speakers we have at our upcoming Meet the Masters is Ken McElroy of Rich Dad fame. You all probably, of course, know who Ken McElroy is if you're anywhere in the real estate world. He has spoken at 2 of our other events before, and he will be talking about the infinite return thing that Sara mentioned just now. We also have Sharon Lecter, who was co-author on, I think, the first 10 Rich Dad books, and then economist Harry Dent, New York Times bestseller, many, many books. We also have Todd Davis, who is a 7 Habits of Highly Effective People. That's one of my favorite books. Stephen Covey passed away a few years back, but Todd Davis did a great presentation on that, and he works for Covey, and so he'll be speaking. And then my friend George Gammon, who's got those awesome whiteboard videos on YouTube.
I love his whiteboard videos. They're so good.
They're excellent. I wish I had that skill. He's great at it. So they're all speaking at our upcoming Meet the Masters conference, jasonhartman.com/masters. Get your tickets for that. And one of the things we'll be talking about that event is, my pandemic investing strategy and presentation. And so I want to share just a little bit of that with you now, a couple things today before we go. I just thought I'd share a few of those slides with you so you can see what we're talking about with pandemic investing. Okay, so let me just get this set up. Okay, I think that'll be the good view, and I will share my screen. Here it comes. All right, I think you can all see that probably, and maybe I'll just make this a little bigger so it's easier to see. I've got one of those big panoramic monitors, and I love it, but it's weird with the screen sizing. The screen sizing is odd with it. So anyway, this is a presentation I have been doing, and I'm getting a lot of acclaim on this presentation. One of the things we've got to remember is that, and this is sort of an odd saying, but in a recession or a depression, the person who wins is the person who loses the least. Okay, remembering that economics is a relative game. It's a relative game. And as such, we don't have to necessarily get ahead as much as we want to get ahead. We just have to minimize losses, okay, sometimes. So one of the ways to do that is to invest in good, prudent income properties. The other thing I want to mention to you is this old concept you may have heard before, that the Chinese have a symbol for crisis that is the same as the symbol for opportunity. And literally translated, it means crisis is an opportunity riding the dangerous wind. I mean, isn't that cool? Think about that. Crisis is an opportunity riding the dangerous wind. Yeah. And one of the many huge opportunities we have during this time is what I believe I was the first person to predict this. And that is this mass migration out of urban areas to suburban areas. I predicted that way back as we were hearing about Wuhan, and Italy was just starting to be a problem. That's when I predicted that, okay? So as such, let me just show you another slide here. I go through my futurist presentation, supply demand shock. What I want to get to is I want to get to a point that I have about roommates, which is quite interesting. Okay, and this presentation is long. There's a lot to it, I'm not going to go through it here. But I do want to get to just one point about roommates, which is quite interesting. Okay, and it's not there. That's the migration. Here it is. Here it is. So this is pretty amazing, folks. And you probably never thought this was this significant. Okay, but this shows the number of roommate households in the U.S. over a 10-year period. Okay, and it's actually increased since this chart. We've already got updated data on this. But what you'll notice is that in expensive cities, there are more people doubled up. Now, that's probably not a surprise to anybody, right? You'd think that, well, the more expensive the cost of living in a highly urbanized, cyclical market, whether it be Boston, New York, any of these major cities, right, where they're crowded and real estate's expensive and the cost of living is high, okay? In those markets, more people double up as roommates. Surprise, surprise. Not that much of a surprise. But think about this, and think about this hypothetical conversation I want to share with you, okay? If we have 32% of the country living as roommates in platonic relationships, these are not romantic relationships. They're not, couples, they're not marrieds, they're just roommates, okay? And think of this conversation that must be taking place in millions and millions of roommate households. Okay, they used to go to an office and they used to maybe hardly ever see each other. They just come home to sleep. Maybe they're young professionals, they've got busy social lives, and they go to work in the office. Maybe they come home, or after work, they go directly to the gym, or they go out and meet friends for a social occasion. And then they come home to sleep. They hardly ever see their roommate except to leave a note on the counter of, hey, did you pay the rent this month? Or clean up your dishes in the sink, right? Typical roommate life, right? But now they have this conversation. Since the lockdown, my employer has told me to work out of the house. And the other roommate says to the other, and my employer is saying the same thing. And, we live in a 2-bedroom apartment or, 2-bedroom condo. And now I need that extra bedroom for a home office. And guess what? The gym is closed and there's no gym to go to. There's no place to work out. They are tripping over each other. They're going crazy in this environment, okay? They need to split up. So if you think about 32% of the households in America having this conversation, okay? And if they split, they've literally doubled the demand for housing right there just in the roommate sector. That doesn't include the possible COVID baby boom. It doesn't include the possible COVID divorce rate increase. Okay, we should have asked Gina about that one, Sara. she's the mental health professional. That would have been.
We'll send them to Sara for counseling.
Yeah, and so we don't talk about that. We don't talk about any of the other factors. Simply this. Now, I've got a little ticker I'm going to put up on the screen here, and it is one I haven't showed you yet. And here it is, okay? Kitchen upgrades are overrated. What everybody wants now is a home office or 2 home offices. Think about this scenario. Think about a family of 4. You got a couple and 2 kids.
That's
All
me.
those kids are now having, that's you, Sara, right? You got your husband and 2 kids. All those kids now have to study at home, all 2 of them in your case.
Yeah.
So they've got to study at home and do school at home. And most of the schools have now said that they're not reopening in the fall. And Harvard University, which is a complete ripoff, total ripoff, is not lowering their tuition rate for kids that have to now learn online, no college experience anymore in the fall. So you're going to pay the same $47,000 a year to sit in front of a computer screen and take your classes. Absolutely ridiculous.
Insane. That's just insane.
It's totally insane. And so people are working at home. So the two parents are now working at home, and now the two kids are studying at home. Okay. What this all means is an increase in demand for the size of the house. The home has become the center of the universe, and people want more space. Now, you might be thinking, well, Jason, we're in a recession. Maybe they can't afford more space. You're right. This recovery is very uneven. Some people are doing better. Many are doing worse. No question about it. Wouldn't deny that for a moment. But the way they improve this situation and the way they get more space is by moving out of the urban environment and moving to the lower cost suburban environment. So the typical scenario there is, and I have friends that are currently doing this right now. A friend of mine, Cody, okay, he lives in New York City, has a girlfriend. They are now moving out of New York City to South Carolina, okay? Yeah. They can take their cost of housing from a tiny little apartment that's maybe $4,000 a month. I think his is $3,800 or $4,200 or something like that. I'll round it off at $4,000 a month, and live in a suburban environment where they could rent a house that's triple the size for 1/3 the cost. Okay.
Well, and Jason, if you recall, we did this coming out of the last recession. You know, I used to commute to our office in Newport Beach. And when I first transitioned, when you moved out of state and I started working from home, yep. I couldn't work from my kitchen table. We needed an extra room, and we became renters. It was a much better deal for us to be renters in our market at that time. I mean, we looked to buy a house.
It's still a better deal. I know you bought your big house, but yeah.
We did buy back in, but actually becoming renters allowed us to do more with investing. But yeah, we experienced that in the last recession, and we became renters because I needed an office, and now you got the kids that need an office too. So it's just crazy.
Absolutely. Okay, so no question about that, Sara. You are absolutely right. Let me put this on the screen. Okay, and this will be the promo code. Okay, for $100 off.
Meet the Masters. This is a client favorite. Okay, we do it in person every year, and I've attended every single one since I started working for you in 2007. And even being in the industry, I learn something new every time. So I've had so many clients reach out, and they're so thankful that it's virtual this year, because a lot of times people just can't make it for one reason or another. So definitely, if you've been wanting to come to this conference and you couldn't for whatever reason, this is your chance.
Yeah, absolutely. And we've had people fly from all over the world to come to this conference. People from Australia. I remember last year I was so pleased when one of our podcast listeners flew from Perth, Australia, 22 hours just to come to this event.
So he's registered for this year, Mark.
Oh, he is, yeah. Great.
Yeah, he said, it's going to be 3 a.m. I'll try and stay up.
It's a lot easier than that flight, although we definitely appreciate you coming. That was super awesome that you came.
Yeah.
But getting up at 3 a.m. and having some coffee is much easier. So there you go. Ken McElroy, Sharon Lechter, both Rich Dad authors, Harry Dent, famous economist, our whole team, several of our property management people, our local market specialists, our investment counselors will be doing panels, we'll be doing all sorts of great stuff. This is our 22nd anniversary event, but it's the first time we've ever done it virtually. And go to jasonhartman.com/masters, get $100 off with the promo code JHLive. By the way, that's not case sensitive. I wrote it that way just to make it easier to view or remember, but you should be able to do that either way, and it'll be $100 off, and that will only work for the next hour after we say farewell today, okay? So you do have to sign up, JH Live, and it's totally virtual, and it'll start out Friday evening with a virtual happy hour, which will be kind of fun. And Sara, guess what I'm introducing there? Besides having Sharon Lechter speak about her book, what's it called? Outwitting the Devil. That's such a great book, which is basically a Napoleon Hill story. She did a deal with the Napoleon Hill Foundation. He's the author of Think and Grow Rich, maybe the most famous self-help book ever back in the 1930s. And I will be introducing at our happy hour. You don't even know this, Sara, but you'll like it.
I can't wait. Tell me.
I know you're a fan of Bloody Marys. I'm going to be introducing the cash flow cocktail.
The cash flow cocktail.
Cash
Wow,
flow
I can't wait.
so good stuff, and that'll be at Meet the Masters. So yeah, this has been a real favorite of clients. And Sara, what else do you want people to know about that event?
Just, hey, you can attend with a spouse, a friend. Typically, you have to purchase 2-3 tickets to bring your family. This is like, 3 can come for 1.
Right.
And have fun with it. Join us for the happy hour, the kickoff on Friday night. It's a ton of content. So we do offer a recording. Get the recording so you can go back if you have to miss an hour here or there. Don't worry about, hey, on Saturday I got to ditch out an hour early. There, we will offer a recording. So don't miss it. It's an awesome event. And hey, we're in like some uncertain times here. So, you gotta set yourself up for success and figure out how to beat this thing with us.
Right. I want to show you one more thing here. I've talked about this mass migration from urban areas to suburban areas. Look at this map on the screen. It'll blow your mind. This is one of the things we'll be talking about at the Meet the Masters Income Property Conference. So these are triple digits in some areas, areas with the greatest net exodus end game. Okay. Look at the migration trend that's going on. This is happening all around the country. And frankly, it's happening to a lesser degree all around the world. But the difference is the U.S. has a very favorable situation because the U.S. has much more in the way of suburban markets than other parts of the world do. Suburbia is an American concept, really. And it happened because in the post-World War II environment where the baby boomers were creating homes and families, and there was this massive building boom after World War II, we saw the American love affair with the automobile, okay? And the automobile made suburbia possible. And that was a distinctly American thing, okay? Yes, we have suburbs around the world. I get it. I've been to 87 countries around the world personally, but in America, you really have this opportunity. The U.S. real estate market is very, very unique. And I remember in English literature class in 10th grade, we had to read The Grapes of Wrath by John Steinbeck. And, I watched the movie of that last week, and it was really interesting. I'd highly recommend you watch the movie to see this mass migration that happened during the Depression as people were going to California. Okay. And
now they're leaving.
and now they're leaving. And that's back when California was a friendly state that attracted people. And now it's doing everything to repel people, sadly. Same with New York. And look at where people are leaving. Look at where they're going. Wayne Gretzky has that famous quote. It's cliche. You've all heard it. He said, the secret of my success in hockey is that I try to skate to where the puck is going. And where's the puck going?
Yeah.
You see it on the map, right? Sara, go ahead.
Yeah, I was going to say, get ahead of it. You know where it's going, get ahead of it, get in the way of it. If you're an investor, don't wait, get ahead of it. And hey, you don't have to leave LA. I love LA. I'm staying here for a little while. I don't know. We've been hey, I know a ton of people that are moving to Arizona right now. My whole family's leaving.
You can't blame them.
Yeah. It's crazy. It's crazy times, but yeah.
Yeah. Well, I grew up in Los Angeles and then lived in Orange County as an adult and moved to Arizona in 2011. Lived there for 6 years, lived in Las Vegas for 1.5 years, and now I've been in Florida for over 2 years. And I think I'm going to stay
Are you
put.
gonna say? I was gonna say I didn't think the Vegas life was gonna be for you.
No, I'm not a Vegas person at all.
Yeah.
Yeah, you know, I go to bed at like 9:30 at night. So I'm not a Vegas guy, but I do like no state income taxes, and Nevada
I
has
bet
that,
you do.
Texas has that, Arizona has that, and a few other
Right.
places. So yeah, get
Good
into a place with no state income taxes. Sarah, anything else we should share? Do we have? I don't think we have any more questions. I think we've
No,
addressed.
I think we got it. And thank you all for being here. And hey, call us if you have questions, if you need help with your refinance strategy, your HELOC strategy, we can help you with that. And we'll be talking more at Meet the Masters as well.
Yeah. And of course, we can also, any of our investment counselors like Sara can do a free portfolio makeover for you and show you how to reallocate your assets to their highest and best use. You know, that's a principle in real estate, highest and best use, but it's the principle of money too. You want your money working for you.
Right.
In terms of its highest and best use. And so our portfolio makeover, and it's totally free, can show you how to get the highest and best use out of any assets or money or resources that you have. And that's totally free. Just reach out through jasonhartman.com, or you can call us if you're in the US at 1-800-HARTMAN. Again, that's a US number only, 1-800-HARTMAN. But if you're international, jasonhartman.com, reach out to us either way. Okay. And again, there is the promo code before we sign off, JH Live, okay? JH Live at jasonhartman.com/masters for $100 off. Works for 1 hour, okay? So get your deal now. People have paid more than that for tickets, but it's a special for staying with us today. So again, thank you for all those who joined us. And thank you to David and Gina, and Sara, thank you as well.
Thanks for having me, Jason.
All right. Happy investing, everybody.
Bye. Happy investing.